if the company is making a profit, they can take benefits of that profit. Company structure is one of the key, the most common ones, especially for clients who have already done their research, or like new clients who are looking at setting up business. Company one is the structure that they'll usually opt in. Now, for company structure, we have two different tax rates. It's either 30% or 25%. Now, 25% is for small business owners. So that's it used to be 27.5% last financial year, 2021 financial year. And for 2022 financial year, it has dropped to 25%. And then 30% is for companies that are entities that are big, so over 10 mil, and also entities that have passive income. So they're receiving income, say, from example, rental property dividends. They have $1 million in shares, they're receiving dividend income. Those kind of entities, they will be taxed at 30%. Companies give us some kind of flexibility with tax planning if the structure is set up correctly, and I will go in more detail in the next few slides what I mean by that. Basically, in a company, there are two key roles that we put in place. One is a director who controls and do the daily, if you have lease agreement to sign, or who looks after the day-to-day activities of the company. So one is the director and the other one is a shareholder. Now, a shareholder is someone who basically benefits from the company's profits. So essentially what they do is, if the company is making a profit, they can take benefits of that profit when we declare dividends. Now, what I mean by if held correctly is making sure that the shares are held correctly. Now, we can hold the shares personally through a discretionary family trust or through self-managed super fund. So there's different ways you can hold shares, and I'll go in more detail in a minute with that one. And then the last one is the asset protection. Now, obviously, we want to make sure when you're trading via a company, we have those asset protections in place. So making sure that, the director of the company doesn't have too many assets in their personal name. That is just to protect their personal wealth aside. So if something happens in the company, people can only go after the company's money, nothing personally in the director's name. So we want to make sure that the director's personal wealth or the assets they have bought outside the company are protected.